Good morning, and wishing you a super duper Thursday ahead. Welcome to today's episode. We're talking about three things: US 10-year Treasuries below 1.49%, China's PPI and CPI divergence, and big day for the euro. The S&P 500 wobbled in and out of record territory Wednesday before ending below its all-time closing high from early May. Losses in the financial, industrial, and consumer sectors weighed against gains by healthcare stocks like Johnson & Johnson and tech stocks like Microsoft and Apple. The benchmark index was down 0.2%. The Dow was down by 0.4%, while the Nasdaq was down by about 0.1%. The market has been subdued for much of the last 2 weeks as investors balance their confidence in the economic reopening against the risk of rising inflation, supply chain problems, and the possibility of higher taxes as well. Such worries have contributed to cautious view for the outlook of stocks, which are trading around all-time highs. The S&P 500 is up about 12% in 2021. The treasury markets move this week pose a puzzle for investors. Why, ahead of a report that might show high headline inflation, are traders buying bonds that yield less than 1.5%? The 10-year yield just fell outside the range where it has been stuck for months to its lowest point since the beginning of March. And not only are investors buying US bonds, pushing yields lower, they appear to be clamoring for buying them directly from the US government. A Wednesday auction of about $38 billion in 10-year notes bought in about $2.58 of bids for every dollar sold. That was the highest demand since July 2020, when there wasn't yet a COVID-19 vaccine available and the treasury yields hadn't reached their pandemic lows. On Wednesday, primary dealers, the government's counterparties that are required to bid at auctions, ended up buying about 15% of the auction, the lowest since 2016. This is according to Bloomberg data. Low awards to primary dealers tend to be seen as a sign of robust demand since they are the only group that are required to bid. The auction yield was also lower and the prices were higher than the pre-auction derivatives trading indicated. The 10-year yield was down nearly 5 basis points to about 1.49 in afternoon trading after the sale. Over the long term, bond traders have been paring down their inflation pricing since mid-May, when the Federal Reserve's meeting minutes indicated that officials were starting to think about a timeline for stepping back from their $120 billion in monthly purchases of treasuries and mortgage-backed securities. Last week's job report showed healthy job and wage growth, but wasn't enough of a blowout to change the picture for bond investors. The market's inflation pricing matters because it implies that investors think that Fed has inflation under control, or at least the officials will act to address it before prices start to increase in a persistent and harmful way. The moves could still reverse themselves if today's consumer price index is surprisingly strong, but if treasury yield declines are an implicit bet on Fed's credibility, it may take more than a couple of strong CPI prints to break that trend, is what is getting reported. Moving on to China, and this is an interesting inflation dynamic that I wanted to touch upon. The surge in China's May factory gate prices on the one hand and undershoot in consumer prices relative to expectations on the other show pass-through remains limited. Downstream firms continue to absorb much of the impact of the boom in commodity prices, preventing broader inflationary pressures from taking hold. So the data that came through yesterday was the producer price index rose 9% from a year earlier. This is the most since September 2008, and that was above consensus projection of about 8.5%. The consumer price index, which what you and I are bothered about when we go buy things at the market, rose about 1.3% from a year earlier. So producer price index goes up 9%. The consumer price index goes up about 1.3%, which was below expectations. The gap between the upstream and downstream prices, with the former heating up and the later restraint, widened further in May. The divergence suggests increasing pressure on gross margins of downstream firms, which is your consumer companies. But as long as it lasts, it also suggests that price pressures aren't being transmitted more broadly. So the miners and manufacturers are not passing that price pressure down to the consumer. Gate prices of producer goods, including mining, raw material and manufacturing, surged 12% year on year, on par with the record in August. In particular, raw material prices jumped 18.8%, a record for the series going back to 1999. In the meantime, gate prices of consumer goods just rose 0.5% year on year, up only marginally from 0.3% rise in April. Lastly, on to FX. Euro has a big day ahead with the monetary policy announcement and the US inflation report on calendar. Between these two events, the European Central Bank meeting is generally more market moving. There's little doubt that inflation is on the rise, but Federal Reserve has made it very clear that they see this increase as temporary, with retail sales and non-farm payrolls falling short of expectations, effectively justifying the central bank's caution. A strong inflation report won't increase the chance of a taper talk in June. Dollar JPY may get a boost from a good number, but its gains should be limited ahead of Dollar JPY may get a boost from a good number, but its gains might be limited ahead of Federal Reserve's meeting next week. That is the update. Stay safe and healthy, and I'll speak to you tomorrow.